Hello, I'm Stephen again from TEFAT, and today I'd like to give a presentations on balance day adjustments or adjusting entries and 10 column worksheets, because you need those adjusting entries for 10 column worksheets. I'll just focus the video camera on the whiteboard, just get the correct markings and just adjust the tripod slightly. Okay, so with balance day adjustments, we're talking about entries that are made before balance day. In Australia, balance day is June the 30th. In the United States, balance day is December the 31st. They've got a different financial year. So you've got general journal entries, and I'm just going to run through these adjusting entries. I don't want to labour on them because some of my presentations have been getting a bit too long and I've got to include 10 column worksheets. But one is when in the accounts receivable account where a debtor doesn't pay. Perhaps they've got financial problems or they've fled the country or something, and they were what they were supposed to pay, and first you had debit accounts receivable, credit sales, and then it went to doubtful debts, debit doubtful debts expense, credit provision for doubtful debts. A provision is money, cash that you've got in the bank, actual money, actual cash, a provision to call on, not an accrual, actual cash. And then after doubtful debts, well, I've covered that one, it went to a bad debt where you came to the conclusion that the debtor was never going to pay. So it's a debit bad debts expense, credit debtors, or accounts receivable. Now, you're supposed to put an explanation of the transaction below and the date, but the whiteboard's too small, and I'm just focusing on the debit and the credit, okay? But to complete it, you would need an explanation and of the transaction and the date, who the company is, and so on. Another balance day adjustment or adjusting entry is debit depreciation expense and credit accumulated depreciation. I've got a presentation devoted to depreciation, so have a look at that on the TEFAT website or the TEFAT Gumtree ad in Australia. So yeah, debit depreciation expense on the P&L, and accumulated depreciation is written in non-current assets, where you've got the original value of the asset, accumulated depreciation, which is all the total depreciation expenses. That's not a total figure, by the way. That's just change in accumulated depreciation with that amount. But if it was total accumulated depreciation, it'd be total depreciation expense for the life of the asset to the present day. So that's an adjusting entry. We've got debit perpetual inventory variance and credit inventory. What we mean here is you've done a stock take at the end of the period. Could be a combination of perpetual inventory measurement with the computer and periodic manually counting the stock on the shelf, and you found that there's a variance in the inventory that you thought you had, but some is missing off the shelf. It could be due to theft, obsolescence, perish goods, or faults. Perhaps people in the store or the warehouse have got rid of some inventory and they haven't written it off properly, and there's a variance. So you credit inventory, because inventory is a current asset. You're reducing inventory with a credit, debit perpetual inventory variance. And then because that's a cost, inventory's gone missing, you've got a debit COGS, which is a type of expense, cost of goods sold. what we mean is opening, that's inventory. For example, shoes in a warehouse, opening stock plus purchases equals goods available for sale plus closing stock. And then you credit perpetual inventory variance to close that off. Then there's some payroll entries, which are adjusting entries. Now, what we mean here, we're starting from one period and then we're going to the next period, okay? So you start at one date and you're going into another date. That's accrual. So one period. The transaction that's period one, that's period two. And from period one to period two, things change, and that's why it's called adjusting entry. So you could have two sets of debits and credits, one for period one and then a second set for period two. Okay. Now with payroll, the general format is you debit the payroll expense, for example annual leave, and you credit the provision for the leave, so credit provision for annual leave. In New South Wales, annual leave started with the Annual Holidays Act of 1944 in New South Wales, and long service leave came in 1955. Every 10 years you've served, you get 2 months off leave and have a holiday and a break. Annual leave is 4 weeks per annum. So, yeah, debit annual leave expense, type of expense. Credit provision annual leave, that's actual money that you can call on that when people go on holidays. So if you were just to let it go on overheads, that wouldn't be a provision anymore because you haven't got the cash. You're just maybe getting a short-term loan to pay people's annual leave in the Christmas holidays. But provision is cash, as we mentioned. Debit sick leave expense, credit provision for sick leave. Again, another provision, cash in the bank for sick leave. Debit long service leave, credit provision for long service leave, okay? And doubtful debts we already mentioned I forgot to write it here, so I just put it here. So now I'll just turn the whiteboard over for some more adjusting entries. I'll just make sure it's focused on the video recorder, okay? Okay. So now we've got these adjusting entries. I'll just explain each one. My source is module 2 in, I've chosen the 10 column worksheet of this textbook, and I got these general journal entries out of that book, but these are general accounting acceptable principles, general acceptable accounting principles rather, and they're known worldwide in bookkeeping format. But P. McGrath and R. Walsh, Applications of Accounting Procedures Workbook, National Core Accounting Publication, Sydney 95. So this is one. Expense incurred but not paid yet. And an example is wages. So you debit the wages expense. So what we mean here is you've incurred the expense, right? But you haven't paid for your expense yet. So you debit wages expense and credit wages accrued in the first period, period 1, whether it's a month, a quarter, a half year or a year. And then in the next period, you debit wages accrued and credit wages expense. So that's like if you were to pay that wages expense on the spot, you wouldn't have to worry about 2 periods. But this transaction does go into 2 periods, therefore it's a balanced day adjustment. The next one is prepaid expenses. This time round, you have paid for an expense up front, but it hasn't been incurred yet, and such as prepaid insurance, okay? it's a prepayment, debit prepaid insurance and credit insurance expense in that period, right, period 1. And oh, by the way, that sits in the balance sheet in current assets, prepaid insurance. But in the next period, say the next month, you debit insurance expense as you'd expect. You've probably seen that before. Debit your expenses on the P&L and credit prepaid insurance. Kind of reverse it. Like first you've set it up in period 1, and then once it's been accrued in the next period, you're reversing out prepaid insurance, which doesn't exist anymore, and take it off the balance sheet as well. So that's that one. And the next one is income earned but not received, accrued income. So you've done the work, you've earned your income, but you haven't got your money yet. And that occurs quite a lot, actually, in the business world. So you debit accrued income, whatever the type of income is, whether it's rent or contractual work or whatever it is, label it and credit the type of income again. Credit contract income as an example. But the next period, period 2, however you're mentioning it, month, quarterly, etc., yearly, you debit the type of income and you credit the type of income accrued, okay? So in period 1 you might be used to income as a credit, but period 2 is a bit different because income isn't usually a credit, but we're working in 2 periods. Hence a possible confusion for the bookkeeping student at the start. The next type of balance day adjustment is income received but not earned. So you're getting income in advance, and this is typical with airline flights. You book your ticket, you pay, but like from the airline's point of view, this is income received but not earned. They haven't flown you from Sydney to Melbourne just yet, but you've paid. So it's accrued income. You debit the type of income, whatever it is, whatever the label of the income is, and you credit the type of income received in advance. That's period 1. In the next period, you debit the type of income received in advance and you credit the type of income. And you've seen this before on P&L, credit type of income. That's the one you're used to. This is the one you're not used to because income usually isn't a debit item, but that's period 1. Usually expenses are a debit item on the P&L, but this is confusing because you're working in 2 periods. There's an accrual, okay? So I quoted the source before, and now, I'm going to use McGraw and Walsh now for one of their questions on 10 column worksheets. I use this resource at TAFE, and I graduated in the advanced diploma of accounting, and it's my book and my resource. However, I'm citing the authors, McGraw and Walsh. I've fully cited it, and now I've got to get this so we can. It's on page 340 of that resource, and let's just get it as close as possible as we can. Yep, I think hopefully you'll be able to see that okay. I'll just read it out anyway. You're given a list of figures: sales return, discount received, which is a type of income. Sales return is when you reduce sales, someone's not happy with an item. Gain on disposal, there's gain on disposal is a gain on an old asset, disposable of the non-current assets. Just adjust that slightly. And also you've got capital, which is net assets or owner's equity. Inventory from the last period, we're talking about 30th of June 1996. That's our balance day, but that was the opening stock of inventory in the last period, the 1st of July 95 in the previous year. Purchases, which is in COGS. COGS is opening stock plus purchases equals the goods available for sale. Then you add closing stock. Advertising, salaries for sale, salaries commission, salaries office. These have to go all in the P&L column, and I'll explain how the 10 column worksheet works. Telephone, bank, electricity, freight out, which is part of COGS, customs duty, should be there. Yeah, that's part of the trading account. Sales minus COGS equals gross profit. Below that is the profit and loss account. Bank charges, which are listed in the P&L as a debit. You debit your expenses. Rent is an expense in that column, and doubtful debts is also an expense. Now, now there are slightly different formats for 10 column worksheets, but this format is listing the items here, the details, including closing stock, and whatever the profit is and gross profit, trading profit, net profit or net income, and balance sheet is here. You transfer profit, old profit, to the balance sheet eventually. So you list those, and then you've got your trial balance in the first two columns, where debits usually equals credits. If they don't, you're out of balance. And similar to how a bank teller, if they're out of balance, they're missing some cash. That happened to me in 2002 at ANZ Bank at Ryde. I was looking for $100 worth of $2 coins, and they turned up in the second drawer down. Caused me a lot of stress and anxiety. And this causes a lot of stress and anxiety for bookkeepers. If their debits don't equal credits in the trial balance, it's an important balance, just the same as the money for a bank teller in a bank. Then you've got debit and credit for adjustments. Now, in this adjustment, going over two periods, you've got debit sales and credit sales return. Now, if you debit sales, you're reducing it, and because of sales return, okay? And also, we were told in this question that $8,000 was closing stock of inventory, so we put that in, stock, closing stock, and adjustment. So we've got two adjusting entries here. All the adjusting entries go in this column, okay, debit and credit. And if you have to adjust something over in the trading account or P&L or balance sheet, you do so. This time around, sales was 175,625, but after the sales return, sales was reduced down to 174,610. So that's an adjustment, and it also adjusts a figure in the trading account, which is sales minus COGS equals gross profit. Then you then you've got your trading account entries, debit and credit. That's sales minus COGS equals gross profit. Then you've got your debit and credit entries for profit and loss account, all the expenses below gross profit in the P&L, till you get to net profit or loss. And then two columns for the balance sheet as well. So transpose all these figures the best you can into the profit and loss, the correct, either if it's a debit or a credit. So that figure in profit and loss account is gross profit, which has to be transferred from trading account to net profit. And list all these debits and credits the best you can from the list. Okay, every one correctly. Identify your adjusting entries, which go on the adjustments column, debit and credit. And I'll just explain how some calculations work. I've already explained sales return. How gross profit works. Okay, this is the trading account. Sales minus COGS equals gross profit. That's the trading account. Now, how you get gross profit? Gross profit equals sales minus COGS. You know that from the formula. So that's sales there, minus COGS, which is opening stock on the shelf, plus purchases of the inventory, that item there, gives you goods available for sale, GAFs, and then you add closing stock. Now, you can see both these in the credit, and you add these two, together, going down your ledger, and then you minus opening stock, which is here in the debit. Now we're dealing with debit items in the trading account. So that's opening stock. That's purchases of the stock, say the shoes. You add freight out, okay? That gets added, and we've already added closing stock here, and that gives you gross profit of 37,000, which is here in the debit column of the trading account, okay? And you find which column is bigger than the other, and the missing figure goes in the one that is less than, okay? And that gross profit has to be transferred to the P&L account in the credit item, which is consistent because income is a credit in the profit and loss, and expenses are debit. You list all those expenses, and now we want to derive net income loss. I'll just give you a clue. It was a loss, and it goes in the credit column. But net income is derived as gross profit and any other income less operating expenses, all the administration and the marketing and the financial expenses. So in this example, net income equals 37,000 gross profit plus any other income, $600 for discount received and $5,400 for gain on the disposal of a non-current asset, minus all these operating expenses here in the debit column. Expenses are debit. Now, if you do that, okay, to summarize again, net income equals the gross profit plus any other income, right, minus your operating expenses, all right? That's how you derive net profit in the P&L. So we've just done that, and we've come up with the figure of 4,600, which is a loss. Always put that in brackets. And then with the balance sheet, just list all your balance sheet items, and debits should equal credits for that. Okay, and also old profits, or this time a loss, have to be posted to the balance sheet. So the loss has to be posted in the debit. If we made a profit and we were positive with a profit, you would post it to the credit side because it becomes capital, owner's equity, which is always a capital item. But because we made a loss, it's actually posted to the debit side, okay? We're reducing capital. Yeah, so that's okay. So that's how you derive gross profit and net income, also net profit or loss from the 10 column worksheet method, and you put all your adjustments here, adjust any figure here. So we had to adjust sales return, bring sales lower, and that's how you use this 10 column worksheet sort of like a little calculator, and I'll give reasons why bookkeepers want to use it. So yeah, again, that's a question Jackie C and company from McGrath and Walsh, which I quoted before. Now I'm going to focus the PC on, the video camera on the PC. If you really have to rush off, if you're short of time, but I'm trying to help you with some notes. You might pick up a couple of things here. So I always pick up on some points in my kind of summary. So remember, we're working in two periods with balance day adjustment, period 1 and period 2. I already outlined those on the whiteboard. And then if you've got a provision, that's like hard cash, and you've got actual notes and coins in your bank account, is the word provision. Making an adjustment is adjusting figures in the P&L, recording it in the adjustments column of the 10 column worksheet. Also, these are important categories of balance day adjustments. Your prepayments and accruals, dealing with expenses and income, okay? And just get familiar with those. You might have to remember those general journal entries for an exam situation over 2 periods if you're not given them. Not impossible. Get used to the one you know and memorize the other one that just looks strange, but the only reason it looks strange is because you're working in 2 periods. And you might have to, of course, you'd have to post it to a ledger if you ask that. So how you do that is you go from general journal and go to general ledger. A debit is a debit. Find the one you're looking, the ledger you're looking for first. Go to debit or credit side. Left side is debit, credit side is right side, and then but label it the opposite thing in the transaction. I've got a presentation on double entry bookkeeping. That was my very first one, accounting presentation after economics, and it's listed on the TEFAT website, TEFAT, and also the Gumtree ad. So I've done a presentation on double entry bookkeeping if you're unsure of that. And so yeah, prepaid insurance sits in current assets on the balance sheet, but when it's used up you take it off the balance sheet. And that's, yeah, income accrued, remember that. That's when you've earned the income but you haven't been paid just yet. All right, get used to those journal entries, and then it'll have to be posted to general ledger. And then some of these questions ask you to draw up financial statements too, the P&L and balance sheet. I wasn't going to go through that. Income received but not yet earned, income received in advance. From the airline's point of view, that's when they've received your money, their income, but they haven't flown you just yet to your destination at a future point in time. So over 2 periods. Rent received in advance goes in current liabilities. Okay, maybe you can pick up some of these points as just as I'm scrolling, even if I don't verbally say it. Yeah, bad debts is a type of expense. So is doubtful debts. Doubtful debts has got a provision on the credit side. You just got a little provision just in case someone doesn't pay and it does become bad debt. But sometimes they do pay. They surprise you and turn around and say, oh, here's your money. So it's not a bad debt after all, but it took them a long time. And then in that case, you would reduce accounts receivable and credit accounts receivable and debit bank. That's right. In the revenue statement, doubtful debts is recorded as a financial expense. Okay. In the balance sheet, current assets are put at the top. Again, I've got a balance sheet presentation. Also, with doubtful debts, they usually calculate it as a percentage of debtors. They estimate how many debtors are either doubtful or I think it's 2% might be bad debts. Is an average. They kind of know their average, and they get to know their averages on doubtful debts and bad debts. I've got a presentation on depreciation too. Why there's depreciation, obsolescence, physical wear and tear. That's the general journal entries. Okay, so check out the depreciation and balance sheet presentation, current assets, non-current assets, current liabilities, non-current liabilities. The difference between current and non-current is a year, 12 months. Current falls within a year. And don't forget that perpetual inventory variance, those general journal entries, because stock goes missing, maybe theft or faults, and it's not recorded properly. Also, perpetual inventory variance is recorded in COGS, a type of expense. It started out a current asset, but because it's gone missing, it's now an expense. And COGS is a type of expense, a debit item. COGS is your stock on the shelf, like footwear. With payroll, the general format is debit whatever the payroll expense, credit provision for that payroll expense, actual money for when those leave of the employees falls due, because payroll is quite expensive. You want that money in hand when all these people go on holidays at Christmas and Easter, because if you're short of money and it's on your overheads, you still have to pay. So it's better to have a provision, actual money in the bank. And then you keep posting things along, like trading gets posted to P&L, P&L items get posted to the balance sheet, old profit. And then you finally closed off all your accounts and financial statements of the year. Drawings reduces owner's equity, drawings for the owner, for his or her personal expenses. So just don't forget that 10-column worksheet format. Details on the left-hand side, 2 columns trial balance, debit and credit. Debits equal credits. Your adjustments, debits and credits, adjusting entries. And then your trading account, sales minus COGS equals gross profit. Your profit and loss account, debits and credits. A lot of expenses, a lot of debits. And you're finding net income by gross profit plus your other income, less all your operating expenses, which include marketing and financial, to get a net income figure, also called net profit before tax. Okay, yeah. So net income equals gross profit plus any other income, such as gain on disposal of non-current asset, less all your operating expenses below gross profit and COGS, things like stationery, electricity, and a big list of expenses. Yeah, that's how you get net income. Okay, and then don't forget to transfer profit into the balance sheet. Now, if it's a profit, it's a credit item, part of your capital. But if it's a loss, it's a debit item, because you've actually reduced owner's equity. Okay. Now, that's pretty much it. I hope I've helped you. I feel that that was a good presentation. I did my best, and I'm just trying to help you. And I'm promoting my business, which is TEFAT, Trifolium Economics and Financial Accounting Tutoring, TEFAT in Sydney. I offer economics tutorials and financial accounting tutorials, even uni stats first year. And enough of me and my spiel. You have a good day. Enjoy your bookkeeping. Bye now.